Hello. So welcome to a new ET Capital video, and today what I'm going to be doing is I'm just going to be going over FOMC and the federal fund rate, and I'm just going to give you guys a brief overview on it. Not really go into too much detail around the intricacies, but give you a brief understanding. So if you are a trader and you primarily rely on technical analysis, this will just give you a brief overview of what the federal fund rate is, what the FOMC meeting is, and how you can use it to benefit and aid in your trading, right? In the next video, in the following video that I'm going to upload just after this one, I'm going to go into the details on what exactly happened in this current December FOMC, what the outcomes were, and more in depth into what Federal Chair Jerome Powell said, some of the interesting talking points, and really go into depth in what happened in the charts, why, and just kind of learning from that. And hopefully that can, if you're interested in that, you can watch that video, and I'm sure it'll help your trading. Because I know for me, I'm using this information to guide my trading, to dictate how the sentiment that I'm going to be viewing the charts with, and just to aid in my overall trading, essentially. So yeah, let's briefly talk about this here. Just what exactly is happening over here with FOMC. So essentially what happens is every single month you have this federal funds rate. Now we're currently in a rate hike cycle environment, so a lot of times the federal fund rate, it's essentially irrelevant. There's no changes, nothing happens, it's maintained at the same level. However, you get these certain periods of the year where, well, not the year of, currently it's the last time we've had a real fund rate increases like this was decades ago. So this is really kind of a once in a decade scenario where you've got such rapid increase of the fund rate, and that is why it is so relevant to your trading and to investing, and just to the markets in general, to economies in general. The fund rate is really probably the single most important macroeconomic factor in play. Obviously you could argue some other things, right? But I would say this is one of the single most important factors. And essentially, it's released every month, where they come out with this FOMC statement and the projections and so on and so forth. And of course, it is particularly important right now, as the US and economies globally are trying to combat inflation, and to do that, they're increasing the interest rates, right? So it is particularly important at the moment. Now, essentially, when you're coming into this, when you're analyzing these news events, you have to understand, you have to kind of grasp a picture of the broader perspective. Okay, you have to understand the context of these federal fund rates, right? So if I just go back, you can see here Wednesday, December the 14th. If I just go back to December the 13th, you'll see that CPI year over year was released. It came in at 7.1%. That's below the forecast and below the previous reading. Okay, so inflation has been decreasing, but it's still at 7.1%. Okay, and essentially the federal government has a mandate to keep inflation at 2%. That is their goal, that is their mandate. So although yes, this is an improvement, this is still well above the target of 2%. Okay, so with that being said, that is why the interest rates are increasing, because the Federal Reserve is trying to get inflation under control. And the reason they're trying to get inflation under control is because rampant inflation is absolutely deadly to an economy, right? Economies essentially cannot function with rampant inflation, okay? Now, essentially, so you have to have that context in your mind, right? And what the Federal Reserve is doing is it's a bit of a balancing act. They're trying to combat inflation, but in increasing interest rates, it is essentially taking money supply out of the economy, right? And it is bringing this level of instability to an economy, right? This could see, while you raise interest rates, you could see a lot of people go under. You could see business no longer ceasing to be profitable. You could see, landlords having to sell their properties, right? So on and so forth. It can have this knock-on effect. So the Federal Reserve is closely looking at economic, other economic data points such as the labor market data, the housing market, so on and so forth, and they're keeping a close eye on everything, and they're trying to get this balancing act. They don't want to increase interest rates too quickly because they could bring about economic collapse and mass defaults, but they need to combat inflation. So it's a tricky scenario to essentially navigate. And what they're trying to ultimately do is they're trying to create a soft landing. That is a term you'll hear thrown about a lot. They're trying to create a soft landing, and what that means is they're trying to, it's self-explanatory, right? They're trying to make sure they don't see a large economic collapse, but also they don't want to see rampant inflation. So they're trying to create this soft, nice landing for everyone, and we all hope they can do it. Of course, can they do it? That's a completely another question, right? So right now, the federal fund rate is at 4.5%, and this is really where us as traders, this is where it becomes important. Okay, so we got the context of the FOMC meeting and the fund rate. This is essentially they're deciding on what the rate will be, and they're judging it based on all those factors: inflation, the stability of the economy. Should they increase more? Should they slow down interest rate hikes? Should they decrease them, right? And we can see here, so I use obviously Forex Factory here. It's a great website. It compiles all the major news releases. And as a trader, what you need to know is these three figures here. What was the previous fund rate? What is the forecast? And what is the actual fund rate, right? And really, there are three scenarios that are going to occur in this scenario, right? There was three options that would occur, and I've put this just on this chart over here. So, right, here we go. So there was essentially three scenarios that could occur, right? So scenario number one is you could see a 25 basis point increase, right? So this is a dovish stance, right? This means they're increasing interest rates by less, right? Scenario number two would be they'd increase interest rates as expected. This is generally the most likely, the most probable scenario. And scenario number three was they would increase the interest rates by, once again, 75 basis points, which is what they've been continuously doing. And this is the hawkish scenario, right? So scenario number one is an extremely dovish scenario, okay? And this scenario, what this would do is, I'll just put an arrow here. This would be very, very bullish for the stock market. Right? Very bullish for the stock market. Okay. Scenario number two is essentially somewhat neutral because it's expected. It's been priced in, right? And it's I would say it's more bullish, but it's pretty neutral because it's been priced in, right? Now the statements that occur afterwards hold more weight when it comes to the as expected scenario, right? So I would say neutral to bullish for stock market. Now I'm just gonna reference it with the stock market because it's kind of, that's kind of what everyone is thinking about. But if you reference this to the US dollar, it's the opposite. This would be neutral to bearish for the US dollar. This would be extremely bearish for the US dollar, right? And then the final 75 basis points, which is extremely hawkish. This scenario would be very bearish for the stock market, right? So essentially what you see is instantly, as soon as the basis point is released, the fund rate is released, you're going to see a large move in the markets, right? So these are the three scenarios, and this is what you got to look out for. This is what you're going to expect, right? It's all about the context, and you have to understand the broader context of an individual fund rate release. You got to understand what is the expectation, and if if the fund rate comes out as lower than expectation, what scenario will that have? If the interest rate comes about above expectation, what impact will that have? And you have to have a plan around that, right? So I mean, some people will probably be watching this and thinking this is a bit more complicated than I thought, right? You just want simple numbers, right? Oh, it's less, great, sure. That's not the way it works. You have to understand the context. You have to understand um, the forecast, and you have to understand what would happen if the rate decision came above that or below that, right? Because each one will have its separate context. So really, you have to be paying attention if you're going to fully understand this. Okay, so that is all I'm going to be talking about on that. But also to be mentioned is you can see there's other things here, right? There's the FOMC projections, right? And this is basically the FOMC's projection of inflation and economic growth. So this is just essentially it's less important, but it's essentially projections for the future on inflation and the economy, which then is what the fund rate is decided upon. Okay, so obviously the fund rate kind of just tells you what occurred in the economic projections. Then the FOMC statement, once again, I'll pull that up here. This is the federal issue statement. Now generally they keep this very, very similar. It's changes by one or two words, and it's the same old malarkey every single time. Russia war against Ukraine causing extreme hardship, basically contributing to upward pressure on inflation. Basically blaming the Russia-Ukraine war on inflation. Then they state that their goal is to have inflation at 2% over the long run, and they talk about the target fund rate, so on and so forth, right? It's classic, same old, right? Where I think maybe 3 or 4 words were changed from this compared to the last time. It's basically copy and paste, right? Again, nothing new in here. But what is highly impactful is 30 minutes after the fund rate, you have this FOMC press conference. And this is critically important and something you have to pay attention to, because essentially, again, this is all about understanding the context and understanding the broader picture here, okay? And that really is kind of the main point. If you are a beginner, and you're trying to get into fundamentals, you can't just simply look at this number and say, oh, great, cool, buy, sell. No, you have to understand the context. You have to understand, what real impact is this fund rate having, because there's various different scenarios that can play out, and you have to really understand them. For example, if we were seeing interest rates go down, you have to understand, okay, why are they going down? Is that actually a bullish scenario for the because there's some scenarios where that may not be bullish for the stock market. So you have to really understand the dynamics, right? But as a rule of thumb, increasing interest rates is a restrictive policy, which is going to see the stock market go down as money is being pulled away from the stock market. And it's going to see the US dollar give the US dollar strength, right, as money inflows into the US dollar. So that's the general rule of thumb. But understanding the context is critically important, right? Because you understand then the gravity of the decision making, right? You understand the gravity of, if 75 basis points came out, that would be a massive shock. That would bring about extreme bears in the stock market, because no one is expecting that, right? It would go against a lot of the things they're saying, right? So understanding that context really frames it. And then the FOMC press conference. Now this is also exceptionally important, right? Because as I said here, you can get, for example, this 50 basis point expected scenario, which is going to bring about neutral to bullish. And in fact, actually, straight off the mark, this is FOMC here yesterday. Straight off the mark, we saw a massive drop down. Price came back up, right? Very, all very quick. But ultimately, what you see here is price trended down quite significantly, breaking back below 1800, closing below, breaking this major low over here, and holding below, right? That's absolutely massive. And the reason for this was all about the press conference afterwards, okay? The 50 basis point scenario was completely expected, okay? So the fund rate came out as expected. That's priced in, right? This is the most likely scenario by quite a bit. So it already begins to get priced in. You begin to see price come up as you lead into FOMC. And that is essentially this scenario being priced in. So when you get the release, you kind of tend to see this neutral, perhaps bullish move. Okay? But this is where the FOMC press conference comes in, because the comments made by Jerome Powell, the chairman of the Fed, really impact what happens, because he's talking about what's up next. And that's really what it's all about. What's happening next? Okay? What does the future hold? And what I've done here is I just compiled a list of some of the comments he made. Right? I'm not going to go into detail on these in this video. I'm gonna go more in depth in the next video into some of these comments. Right? So basically, to cut a long story short, I compiled some of the hawkish and the dovish comments. Hawkish meaning increasing interest rates more, right? And dovish meaning slower increases or pivoting completely, right? Now, as you can see here, there's more hawkish comments, and that is, to cut a long story short, as I said, that is the takeaway from the FOMC meeting afterwards. Jerome Powell basically came out with a number of quite hawkish statements. For example, 50 basis points, still historically large hike, still some ways to go. A restrictive policy stance is likely needed for some time. So again, just multiple hawkish comments suggesting that there's more hikes along the way, and that interest rates will be maintained at a high level and will likely see continued increase, right? So that is the hawkish, bringing in that added hawkish tone. So that is really what we had. We had 50 basis point expected scenario, which is relatively neutral, plus hawkish comments. That is a bearish scenario for the stock market and for equities such as gold, and it's a bullish scenario for the Dixie. So I'll just bring up the Dixie chart here if it's going to load, and you can see it's a bit laggy, but you can see the reaction from FOMC, right? Quick spike up, came back down, and now it's beginning to trend up, right? Since the CPI move, we still haven't even corrected the CPI move, right? So this isn't majorly bullish yet, right? But that really is the gist of it, okay? That is the gist of it. Now, I don't want to go into too much depth about the comments and so on and so forth, but really the take-home message here is, if you are a trader and you're trying to learn fundamentals, it's all about context. And in this context, this is the context of the federal fund rate, right? And these are the outcomes to expect. You got to understand the dynamics of when interest rates are increased, what that means. That's a more restrictive policy. That's taking money out of the economy in a sense. It's making money more difficult to access. That's going to pull money out of the stock market and see money being put into assets, like the US dollar, right? So that really is the take-home message. And yes, thank you for watching. So that's all. I'm just going to leave it there. If you have any questions, leave a comment or follow me on social media on Instagram or Twitter and shoot me a DM. But yes, please subscribe, like the video, and for more content like this. And thank you very much for watching.